Welcome to Latrobe Financial's Development Finance webinar, Part 2. My name's Corey Bannister, Chief Lending Officer here at Latrobe Financial, and I would like to extend a warm welcome to you all. We thank you for taking your time out of your business to learn more about us here at Latrobe Financial, development finance generally, and to hopefully learn how we can help you in your business. This is Part 2 of the series, forged on the back of the extremely popular Part 1 that saw over 1,100 attendees registered and a further 600 viewing the webinar at a later time. Pleasingly today, we have over 800 registered for Part 2, which proves that development finance remains to be a hot topic. I should mention, for those of you who have not seen Part 1, we would encourage you to log on to the YouTube channel, Latrobe Financial's YouTube channel, and re-watch that to help lay the foundations for your skill set. However, we will provide a brief recap today of that session. As we move along, we encourage you to post any questions you may have, and we'll attempt to answer them if time permits, and if not, we will respond to you separately at the conclusion of this session. Let's get underway. What we're going to cover for you today is an overview of Part 1. This will be very brief, really just to refresh what we've covered to date. And then we're going to jump into 3 workshops where we take you through 3 live transactions of varying size, ranging from small developments under $2 million to small to medium developments and to medium-large developments. Once again, our aim is to remove some of the mystique associated with development finance and to build your confidence to a level where you can actually get in and have a go yourself. And it's almost time to hand over to our resident expert in all things construction development finance, Mr. Steve Lawrence, who's Head of Commercial and Major Clients here at Latrobe Financial. But before I do, I'll give you a very quick recap of Part 1. In Part 1, we covered off a number of key terms. These terms were very foundation level, terms such as developer, builder, the on-completion value, total development costs, capitalised interest, pre-sales. These are the sorts of terms that you will need to be familiar with if you're doing development finance transactions. And if you're not familiar with those terms, once again, we encourage you to go back and listen to Part 1 of the webinar as we really go into a lot of detail around those key terms. Second, we covered what we need to quote a development finance scenario. There's 6 points generally that we need, such as the location and number of units in the development. We need to know the estimated as-is value, which can sometimes be around the purchase price of the land, any current outstanding debt if there's any, the expected on-completion value or expected sales revenue, the construction costs, the term they require the loan for, and whether there are any pre-sale details. If nothing else, if you can give us those 6 items, we're well on the way to be able to provide you with a reasonable quote. We covered off lightly the funding table. We will cover that in more detail today. We'll use that as we work through the scenarios, and we'll also have a copy available after this webinar for you to use in your own business as well. We talked a little bit about development feasibility. Again, that is the nature of today's presentation, is delving deeper into the feasibility of projects, the funding table, and the viability of those projects. And lastly, we walked through our process. So again, if you haven't seen Part 1, it is good to step through our process so you can see how we operate, what we look for, and how we make things easy for you in the broker landscape. Without further ado, I'll introduce you to Steve Lawrence. Steve has an exceptionally strong reputation for credit skills in this area of finance, built over a long period. Steve's held senior operational roles with Reliance Bank, Prudential Assurance Company, Australian Bank, Advance Bank, Overseas Chinese Banking Corporation, and Westwater Property Group here in Melbourne. So both international and domestic experience. Steve's established and managed mortgage origination programs and credit departments, has underwritten and managed 300 million corporate credit facilities, and also underwritten substantial commercial loans of up to 50 million in loan size. Steve successfully managed our construction and development finance portfolio here at Latrobe Financial and been a key part of the product development and portfolio functions in this area. So without further ado, I'll hand you over to Steve Lawrence, who will take you through the scenarios. Steve, welcome.
Thanks very much, Corey. And as I say, as Corey mentioned today, we're just going through the next stage of our workshop on construction lending. So just a quick overview on our lending products, because we're going to go through three different scenarios. The first scenario will be loans, construction loans that we do that are less than $2 million. And just a quick, just to let everyone know, they remember that it's a 70% of the net realisable value that we lend against. So that is the sales value excluding GST, which is not to exceed 80% of total development costs. Our interest rate on that less than 2 million loan is 8.99, our application fee 1.5%, and our pre-sales are nil for loans up to 2 million. The second workshop that we'll be working on is a loan that we've done from 2 to 5 million, where again in our lending matrix we go up to 65% of the net realisable value, which is not to exceed 80% of total development costs. Our interest rates for that product is 9.95, application fee 1.5%, and our pre-sale minimum requirement is 50%. The final workshop we'll work through is a loan that we've just done greater than 5 million. And on that, we look at deals on a case-by-case basis, and we'll go through that one and I'll show you what we've done. So getting straight into it on the first workshop. So this is the workshop one. As you can see there, what we received is some information from the broker up in Queensland. The information they gave us was it was a northeast Brisbane suburb. They were looking at constructing 6 townhouses. They provided us with the as-is value of 550,000, and the loan that was currently against that property was 400,000. The estimated on completion value was just over 2.6 million on an excluding GST basis. The construction costs were 1.28 million, and they estimated the term to build the 6 townhouses and either repay us at the end or look for refinance would take around about a 12-month term. And as I mentioned earlier, or for all loans under 2 million, Latrobe does not require any pre-sales. So we've got all that information there from the broker. We went to our funding table, and we did an initial assessment on our funding table. And as you can see there on the right of the screen, the 550,000 as-is value we put in. We also put in the debt against the land, 400,000. The construction costs of 1.28 million. The estimated market value, 2.6. And as I mentioned there, under 2 million, our max LVR is 70. Interest rate 8.99, term of 12 months, application fee 1.5%. So this funding table, as I say, highlighted there in the orange colour that's the information that we actually load into the funding table from the information supplied to us on the left-hand side of the screen by the broker. Our funding table, this is an initial assessment funding table, then works out all the information for us. And the next lines down, it puts into the spreadsheet the development cost, the construction costs, 1.28 million. As I mentioned in webinar part 1, Latrobe Financial always holds 100% of the construction costs, which in this case 1.28 million. The spreadsheet works out for us an amount shown there of 64,000, being a 5% contingency on the construction costs. Always require a 5% contingency on the total amount of construction costs. And as I've mentioned previously, that's to cover any cost overruns there may be on the construction. We then show our establishment costs. In this case, it will be 1.5% of the loan amount, and our interest expense that we have gone through in part 1, which is the loan amount times 60% times the interest rate, 8.99%, for, in this case, a 12-month period. And that's worked out to be $98,500.
Steve, just to answer a question that we've just received online around that interest expense, the 60% calculation is in recognition of the fact that it's advanced progressively. Is that correct?
Absolutely right. So our construction product, interest is only charged on the amount outstanding. So if we draw down the money for the land settlement plus our establishment costs, the interest is charged on that initial drawdown. As we draw down month 1, the construction costs might be $50,000. We add that to the loan amount, interest is charged on that amount. Then as we keep adding, interest is charged only on the outstanding amount, not the full amount, only the outstanding amount. So therefore, what we do to do an interest budget item, we find out, and many years experience of mine in this area, we normally go the total loan amount times 60% times the interest rate for the term of the loan. That is an estimated budget item for interest, which 99% of the time is no problems at all, always within the term of the loan. So that's how we work out our interest budget. Again, this is an estimate interest expense, as say approximate amount. So the total cost that we're holding in this development would be the construction costs, the contingency, the establishment fee, the interest expense, $1,479,900. Okay, so that's the cost we've got. We always hold 100% of. Now, with our loan amount at 70%, as we put in that figure up front, estimated market value excluding GST, 2,608,700. At 70% loan to value ratio, as we can see just below, max loan amount based on the LVR of 70% is $1,826,100. That is the loan amount that we are willing to lend for this development. Now, as we've noted there, at this initial stage, of course, we're unable to work out what the total development costs are, and we can only work that out once we receive a valuation from one of our panel valuers, and then we can work out if it exceeds 80% of total development costs. But in this initial stage, we're unable to work that out. But I'll go through how we work it out in a further workshop. So with 1.826,100, we need to hold 1,479,900. So there is an amount over of 346,200 that we can advance at settlement, at the initial settlement. So again, the 4 main items we hold: construction, contingency, our upfront establishment costs and interest expense, we hold them at all times. The balancing item is the amount that we can lend upfront for the initial settlement. Again, 346,200. So the 1,479,900, 346,200 is our loan amount of 1,826,100. However, as we've shown above, the current debt held against the land is $400,000 because they have borrowed approximately close to 75% with an initial financier against the land. We're unable, of course, to go that high. So there is, as we can see, they actually need 1,879,900, being the total cost of 1,479,900 there, plus the current debt against the land of 400. So they actually need 1,879,900. We can't give them that because that would go over our 70% loan to value ratio. So there's a shortfall in this loan here of $53,000 $400,800, which the borrower had to place into the loan. So therefore, we could only refinance the 400,000 debt. We can only refinance 346,200. The borrower had to reduce his loan with his previous financier or his existing financier at the time of 53,800 to allow us to then take the balance of the loan away of 346,200. Then we can move forward with construction. So I hope this first workshop 1, we're going to go through 2 more. Hopefully that's given you an idea of what we look for on a funding table at an initial assessment. So what we looked at, next was how do we service a loan for a loan that has no pre-sales at the end of the day. So there's no pre-sales. So our debt of $1,826,100, we have to service that $1,826,100 day one. I understand that, of course, we do have capitalised interest during the term of the construction loan. But, of course, all financiers will look at worst case scenario that the developer cannot sell any properties during the construction period. And worst case, we're left with a debt at the end of $1,826,100. So in this scenario, the financial information we received from the borrower, it was a couple. In this instance, it was a couple that we lend funds to. They $175,000 was their taxable income. Then we had the rental income there of $129,130. Now that $129,130 there is the interest from the completed properties. So they're building the 6 townhouses, and upon completion of construction, of course, they're going to be able to rent those properties out on completion. So we do take into account the rental income of the completed 6 properties, and in this case, it was $129,130. So the income, including their taxable income that the couple earned, plus annual rental income, we had total income of $300,000. We took into account their living expenses, and they also had liabilities of a credit card and a further owner-occupied home loan themselves. So that we looked at our loan amount of $1,826,000 at a 5.69 rate, which is one of our current investment rate over a 30-year principal and interest period. So the loan, as you can see there, we took into account 2% sensitivity, as you can see. The loan serviced at the end of the day, they can borrow a maximum of $1,899,400. So that loan serviced on the basis of nil pre-sales, because we took into account their taxable income plus the rental income of the 6 that they built, all their liabilities, and on a total loan amount at our investor rate on a 30-year P&I, the loan serviced. So therefore it meet our servicing criteria. So what did we end up doing with this loan? Well, we ended up lending $1,826,100 for a 12-month term. The LVR on the net realisable basis was 70%. The total development costs after we received the valuation was 79.95, so it just scraped into that 80% limit that we set for total development costs. Pre-sales were nil, and the profit margin was 18.25%. Again, we got that from the feasibility we received, which I'll go through in more detail in the second workshop. This deal was already been funded and completed. The borrower started commencing sales of these properties from month 9 of our loan term and sold sufficient amount to pay our loan out in full. So this development, again, we had no pre-sales. We did service it at the end. They commenced their marketing program from month 9, once the property was a bit more advanced and in construction, and at the end of the day, we were paid out in time.
Just to pause there, Steve, quickly on that point you make about starting the marketing campaign at month 9 as opposed to doing it before the dirt has turned. Typically, what are the advantages for developers around that?
The advantages for developers is they can, I suppose, twofold at the end of the day. As people see the properties, only 2 or 3 months away, or from being complete or very close to being complete, they can see what it's going to look like, get a bit of a feel what it's going to be like, instead of it being just a block of vacant land. So they can get, they can say, right, this is looking good. This is probably something I would like to purchase and live in or invest in. But also for developers, they may not be able to get as high a purchase price themselves as developers if they sell it off the plan, and people were just looking at a block of vacant land. They might be looking at some nice pictures, but they don't get the feel. The purchasers don't get the feel, but the developer can then hopefully sell it because it's looking nearly finished, looking good. He can get people to buy these properties and at hopefully higher prices, which has been the case for a fair period of time now.
Great, thanks, Steve. So just to summarise, obviously it's getting to site quicker, so less interest holding costs while you're waiting to turn dirt, and second of all, hopefully a higher sales revenue at the end based on
because a lot of financiers in the industry at the current time are asking for in excess of 100% of pre-sales, and therefore, for developers to actually get finance, they've got to have to sell them. They have to sell a fair bit of the stock at, you would suggest, lower prices to get the pre-sales up, to get the finance to build it. Whereas with us, it's we're not asking for any pre-sales for loans less than 2 million. So if I move on now to workshop 2, which is a construction loan that we have well underway, not quite finished yet, but it's about 10 months into construction at the moment. And this is a loan where we was given information from the broker in the early stages. It was a 10-house development in a Western Sydney suburb with the purchase price, so it's not a refinance, this is actually the purchase price, was 1.62 million for the land. The sales value was estimated at just over 5.5 million. The construction costs were 2.368 million, term 15 months, and they'd already had 4 pre-sales totaling to just over $2.2 million already pre-sold. So as we can see there in the orange colour cells there, we loaded in the as-is value of 1.62 million. Of course, we couldn't load any current debt because there wasn't any current debt because it's being purchased. The land is being purchased. The construction costs were 2.368. The estimated market value 5.5 million. And as I mentioned earlier, on our loans between 2 and 5 million, we go to a maximum loan to value ratio of 65% of the sales less GST. Our interest rate for this product between 2 and 5 is 9.95%. The term will be as 15 months to construct and sell and pay us back. And our application fee is 1.5%. So at a 65% LVR on the 5,542,700, if we just go down there to the max loan amount, at 65%, 3,602,800 is a 65% of the 5,542,700. So that's the maximum loan amount that we can advance. Again, our spreadsheet there puts in our development costs, or the development cost, construction costs, 2,368,000. It then works out a 5% contingency. Again, we hold for cost overruns, if any, 118,400. Our establishment costs would have been 1.5% on the 3,602,800, plus a portion that we add on as an estimation of the legal fees, so that's 64,100. And our interest expense again, same as the last time, $3,602,800 at a 60% times 60% times 9.95% being the interest rate over a 15-month term. And that is estimated, as we said there, interest expense budget approximately $268,900. So we have a loan there, $3,602,800, of which we have to hold $2,819,400. So there's a balancing item there, and that balancing item is the amount that we can put towards the purchase of the land. And that figure there, as you can see, is $783,400. But as we mentioned earlier there, the purchase price was $1,620,000, and therefore the borrower will have to put the difference between the 1.62 million and what we can advance then, 783,400. They will have to put that money in upfront as their equity into the deal. So therefore at 783,400, our LVR turned out to be 52% of the as-is value, the purchase price, which of course is under our maximum amount, as we've shown there, of 65%. So again, we held 100% of development costs, construction, contingency, establishment costs, interest expense, and the balancing item is the amount that we can put towards the purchase of the land. And therefore, the borrower has to put the difference in, and as we always, they put their equity, so therefore they're putting all their equity in up front, and we're holding everything we need to build the property at the end. So in this case, we obtained a valuation and a quantity surveyor's report, as of course we received the same on the previous workshop. But in this time, I just wanted to go through the feasibility specifically for this loan. The value we used here, one of our panel valuers, LMW, came up that the sales revenue is $5,815,000. There are selling costs, and there is GST paid on the amount of $5,815,000. They also show there in their development all the costs. Now this is all the costs. We hold, of course, construction, interest, contingency, and their finance fees, but there are many other costs that are involved by the developers have to pay to before they can start building the development. So they've got all their costs involved there, and that's why we talk about total development costs. So with the sales revenue on a net of GST basis, less all the costs, the net development profit there was $903,400. $903,040, which is a profit margin of 19.97%. As I mentioned in the webinar part 1, we, La Trobe Financial, require a minimum 15% profit margin in all circumstances. We will not go below 15%. So in this case, 19.97% met our requirements very nicely. So that was good for us. Then the next line down is the residual land value. Again, when valuers do these types of valuations, they start with the sales revenue first, and then take off all the expenses. and then they take off, of course, the profit margin, and what you're left with is the residual land value, the value of the land that the valuer states, which is the value, which is what we call the residual, the project-related site value, the residual land value. And in this case, the valuer has put that the figure is 1.524 million, and as you can see, or as we mentioned earlier, they have paid 1.62 million for the land on the basis of a construction deal. They will make 903,000 profit, but the valuer makes the residual land 1.52 million, and that's the figure we use for on an as-is basis there. And I'll show you how we ended up with this transaction on the basis that when we did the initial settlement, we got the valuation in. There were a couple of minor changes that we had to work through once we received the valuation in, and we received the quantity surveyor report in, and I'll go through that in a couple of slides. The servicing aspect, of course, for this loan, we had 60% of pre-sales, as I mentioned earlier there. So therefore, our loan wasn't fully covered by pre-sales. So with the pre-sales that we had of 2,217,000, less our loan amount of 3,602,800, there will be a shortfall at the end that we need repaid after the pre-sales have settled of 1,385,800. So that is the loan amount that we're going to have to service the loan on, which is our loan amount for construction less pre-sales. So what we did, we got, again, financial information was sent to us by the broker, and this was a company loan, and the net profit, their net profit before tax was shown as 148,200. The remaining stock, so there's 4 pre-sales, 10 townhouses, there's 6 of the townhouses yet to be sold. So what we do is we take those 6 townhouses, the rental income that can be obtained from those 6 townhouses at the end that have not been sold, and the annual rental income from those was $219,700. That was the total income, 148.2 net profit for their and the 219,700. That was the total income for the group. Of course, we got their living expenses from the people behind it, the sponsors behind it, and their family. They had a credit card. They actually owned their house, so there were no other debts. And then what we did, we got the 1,385,800. We serviced that again at our investor rate of 569 on completion, and we did a 30-year principal and interest loan, and with a 2% sensitivity added on as well. The loan serviced 2,469,300 is the maximum loan amount, so it serviced quite comfortably. So again, we could push on and approve this loan.
So just to answer one of the online questions, Steve, or just to clarify what you've covered, where the applicant's strategy is to build and hold, they'll obtain a certain amount of pre-sales. We're looking for serviceability on that residual amount.
Correct.
And if that can be proven, then absolutely there's certainly no issue with us doing a build and hold type scenario. So
correct.
To the people that have posted those questions, hopefully that clarifies it. Thanks, Steve.
Yep, correct. Okay, so what we ended up doing, we ended up doing a loan amount of 3,523,000. The net realisable amount came in a fraction lower than what we anticipated up front when we did our initial assessment. So what that meant, our loan amount was in effect 79,800 lower. Once we had the valuation and the quantity surveyor report, it came in a little bit lower, the sales value, and we could only, once with 65%, our loan amount was 79,800 lower. Therefore, what we did is, instead of being able to lend them up front an amount of 783,400 for the land, we could only lend them 703,600 for the land. and therefore they had to put their equity in, being the purchase price of $1,620,000 less what we were able to lend them for the land of $703,600. So therefore they had to put those funds in day one for us to take the security on. And again, they were able to do that, and we can move on and do the deal. Term was 15 months, LVR 65. Total development costs were 77.9% for this transaction. We had 62% pre-sales of the loan amount, and the profit margin, as we saw in the feasibility earlier, was 19.97%. So all up, good deal. As I mentioned there, we're 10 months already into the deal, and in another few months, hopefully it will look as nice as the picture we've got there. Moving on to our final workshop 3. This was quite a larger loan for us at in excess of $5 million. It was an 8 apartment development in a northeastern Sydney suburb, and the broker advised us again those 6 items that we asked for. 8 apartments, northeast Sydney suburb. The as-is value was $3.1 million. They had a loan already against it of $1,440,000. Their estimated sales value on an excluding of GST basis was $9,862,000. Construction costs were just over $4 million. They're anticipating the build and to sell close to the end and pay us down to be 17 months. And they already had 4 pre-sales, totaling $5,355,000 already sold, which was quite pleasing to us. So again, the initial funding table there, we loaded in the $3.1 million as-is value, current debt because they had one of $1.44 million, the construction costs of just over $4 million, the estimated market value of $9.8. We did this deal, as I mentioned earlier, case by case. We decided to do this deal at 65% of the sales value less GST. Our interest rate on this loan ended up being 10.25%. As I've mentioned earlier, our interest rates on loans between 2 and 5, 995, less than 2, 899. This was above, outside our 2 to 5 million range. So we ended up, the interest rate was 10.25, and our application fee for this deal was 1.75. So again, as we've gone through before, the spreadsheet's loaded in the development costs of construction, a 5% contingency, establishment costs, which was the loan amount times 1.75 plus a little bit extra to cover legals, and the interest expense again was the loan amount times 60% times the interest rate, 10.25% over a 17-month period, gave us an estimated amount there of $558,500. So the total cost for us there were $4,973,000. The loan that we could advance at 65% of $9,862,000 was $6,410,300. That is the amount that we could advance for this deal. If we deduct the total costs that we need to hold, construction, contingency, establishment and interest, it meant we could advance an amount up front for the refinance of $1,437,200. They needed a refi amount of $1,440,000, so there was a $2,800 shortfall, which was comfortably met by the borrowers, and we were able to move on and issue an initial indicative letter for this transaction. We got our valuation, the indicative letter, of course, was accepted. The borrower wished to proceed on. We got a valuation done, M3 valuation in this case, and we obtained a quantity surveyors report, and we received both of those reports back, and as you can see there, the valuer's feasibility showed a gross realisation there of $10.7 million, and when they excluded the GST and sales costs, the profit, they put in a profit factor of 19% there. All the costs, the construction, professional fees, statutory fees, etc., the profit that was made for this deal was $1,545,000, which, as I mentioned, it shows there 19.04% profit margin, which is above our 15% profit margin that we always ask for as a minimum. So met our criteria there. The residual project related site value, the residual value of the land, after they took into account all the sales, less all the expenses, less the profit margin, $2,855,000, which was a little bit less than what we were advised up front, but it still didn't stop us doing the deal, because when we advanced the funds on the land, it was well below our 65% maximum LVR on the land. So again there, good profit margin, and again it's give us good comfort factor that this is a deal that we wanted to do. Servicing here, as I mentioned, they had 4 pre-sales for $5,355,000 with our loan amount of $6.410 million. There was a shortfall of $1,055,300 that we had to make sure that could be serviced on completion. Again, they're the details that we received. Again, it was a company borrower. $158,500 was their net profit before tax. Met our standard criteria. Annual rental income from the remaining properties. There was 8 apartments being built. 4 had been sold. There were 4 left. The rental income on those 4 left upon completion of construction was we estimate $219,700. We received that information from the valuer that is the rental income that should be obtained for those 4 properties at the end. So total income there, $378,200. Again, living expenses, the sponsors behind the company had a credit card, $25,000 limit. They had an owner-occupied home loan of $600, which they were paying there. So we had to service that $1,055,300. Again, the 5.69% was our investor rate there over a principal and interest 30-year period. So again, it's serviced quite comfortably there with a monthly result there, 736646, positive on a monthly basis. So therefore, it's serviced very comfortably, and again met our servicing criteria, and we could move forward with this transaction. So what happened here? This development is currently under construction. It looks very nice. $6,410,300 were the loan amount. The term 17 months. We advanced 65% on completion. The total development costs were 77.9. Again, under our 80% criteria. Pre-sales were 84%. With regards to loans above that $5 million limit, we look at pre-sales on a case-by-case basis. We do look at more than 50%, which is our requirement for loans between 2 and 5. We probably look around that 60 to 70% pre-sale level for those loans greater than 5. In this case, this was 84%, so we were very comfortable with the pre-sale level for this transaction. The profit margin there was 19.04%. So again, met all our criteria, and this is currently under construction, and I recollect it's about 4 months under construction. So there's early stages for this one at the moment. So just sort of recapping, our products under 2 million, 70% of the net realisable, not to exceed 80% of total development costs, nil pre-sales. Our loans between 2 and 5, 65% of the net realisable value, not to exceed 80% of total development costs, and minimum 50% of the loan amount to be covered in pre-sales of the loan amount. Over 5 million on a case-by-case basis, but the max LVR would be 65, again not to exceed 80% of total development costs. And we would be looking at a pre-sale level a bit higher, probably around about that 60 to 75 range. Again, if the loan is a little bit higher than this one here of 6.4 million, we may require even more pre-sales. And again, this is reviewed by the team on a case-by-case basis. And again, our 15% profit margin was met at all times. Servicing was met. So they're the three scenarios or the workshops there we've gone through, met all our criteria, and hopefully that has given you a bit of an overview of what we do and what we look at when we actually assess each loan once you have given us those 6 items that we do ask you to give us up front.
Thanks for that, Steve. Great presentation. What you got on screen now is a copy of the funding table, and that seems to be the popular item based on the questions coming through the webinar. So we'll certainly make that available to everyone who's requested a copy. I think it's a great document, Steve, that the brokers can use in their office. It seems to be pretty easy to follow, but as always, if they have any questions along the way or they get stuck, they can feel free to reach out to their local senior manager client partnerships or call our credit team direct, and we can certainly walk through that process with you. So what next? I think it's really just digging in and getting started. We do have about 10 minutes up our sleeve to answer a couple of questions off the cuff, Steve, if you're ready and able.
Yep.
The first one is probably the most important one, and that's the question here. What part of your policy makes La Trobe a better option than some of the others in the marketplace?
Sure. We at La Trobe Financial, we go up to. I mean, there's many, but I'll give you the major ones at the end of the day. The first one is we go to 80% of total development costs. I know a lot of the financial institutions out there will not go that high. So therefore, a lot of the major institutions are probably looking more at your 70% of total development costs, maybe 75%, but I do not know too many that will go to 80% of total development costs. So that's one point there. The second point is pre-sales. In the current market, a lot of the major institutions are looking for well in excess of 100% of pre-sales on all types of deals, even the small deals under 2 million. They want 100% of pre-sales. Us, as I've mentioned, we do no pre-sales up to 2 million, 50% between 2 to 5, and even on some of the larger ones, we're not even asking for 100% of the pre-sales. So that is a big plus for us, I suppose. At the end of the day, we're willing to. People might ask, well, why are we willing to do that? But we do that on the basis that if those pre-sales proceed, we take 100% of the net sale proceeds once the certificate of occupancy has been issued and the titles have been issued. All those pre-sales settled, we get 100% of the net proceeds. And therefore our loan to value ratio on the remaining stock we have will be significantly below the 65%, probably somewhere like your 40s and 50% LVR, much lower LVRs, and it's been proved to be very, very successful for us over many thousands of these types of loans. Also speed to market. We've got a team of BDMs. We've got a commercial team that know product, can make decisions quickly. You don't have to muck around and pull your hair out and wait for other institutions to make up their mind on what they want to do. We can tell you fairly quickly, absolutely fairly quickly, on what we can do. Does it meet our criteria? If we can't do the deal, we'll let you know very quickly that we can't do the deal. No mucking around. We get it done, speak to market. You can speak to the decision makers, as I've mentioned. So there are a few points that that really distinguish us from others in the market.
Thanks, Steve. Now the next one is a slightly tougher one, price. So this particular broker has noted that the interest rate is a little higher than what they may get from the major banks. And how do they have that conversation? The question is how they have that conversation with their client to overcome that initial fear factor of seeing a higher interest rate.
Sure. Okay, so I suppose a couple of points there. I mentioned speed to market. I talk to a lot of brokers out there in the market who have gone to some major institutions and were discussing a development deal and speaking to relationship managers who said, yep, we might be able to do this, we should be able to do that. Well, it's gone to their property team and it's gone to their credit team. It might not be the total amount that they were looking or needed to do in the first place. Again, we have that higher total development cost that we're willing to do. So we try and make the deal work at the end of the day. Also, we can knock deals around fairly quickly. We can have an indicative out to you in that 2, 3, 4 day period at this point in time, and we can then get the vals and the QSs. So the developer, instead of waiting for other institutions to make their mind up whether they want to do the deal or not, we've already done it. So therefore, they've got less holding costs at the end of the day. And with the pre-sale levels, as I've mentioned, you go to some major institutions, you've got to sell your stock 120% loan amount. And as we know, a lot of people off the plan, if you don't have as much pre-sales, more often than not, you'll be able to sell them at higher prices at the end when they see some of the stock. And with regards to that, again, they can sell them for higher. They have less costs, less holding costs up front, and we can lend more, and we can do it quicker. And so therefore, there is a bit of a premium compared to the banks, but you either just wait until you get an answer. It might not be what you require. You have to put more equity in. You might not be able to sell it. You might be selling it for lower because you're asking for. So therefore, at the end of the day, it could work out well cheaper. And we know in a lot of circumstances, it does work out cheaper coming with Latrobe Financial.
Thanks, Steve. Next one we've got is probably a complex question around GST, but bearing in mind we've only got a limited amount of time, a quick summary around, is the GST funded via the client themselves fully, or can it be included in the calculations?
With respect to the GST, well, look, we can by all means do the construction costs on an inclusive of GST basis. But if we do that, of course, the amount that we can advance for the land will be much less. So yes, we can. Construction costs can be including or excluding. If we do including, absolutely, it will mean they'll get less on the land. If we do excluding, the developer, of course, will have to pay the GST portion to the builder. But under the rules, they can go to the ATO on a monthly or a quarterly basis and recoup the GST that they have advanced, and recoup that from the ATO, and then that will top up then to make all the balance of the GST payments as they move forward. But we can look at both. the larger type deals you'll find, or the smaller type deals you'll find are including GST, but the larger type deals are normally excluding GST. But if we do include GST, you've got to remember that the amount because we're holding more, the amount that we can advance up front will be higher.
Thanks, Steve. A couple of quick ones. Pre-sales, arm's length, what's required?
Yep, so our pre-sale requirements are as follows. 10% deposits paid. 2, not to related parties. 3, must have a sunset clause date that is 6 months past our anticipated expiry date. So again, 10%. Look, there may be half a dozen pre-sales. One might have a 5% deposit. We're willing to consider that on a case-by-case basis. But to be honest with you, if someone's put $1,000 down on a pre-sale, that won't meet our requirements. We do, the majority of the circumstances, we want to see a 10% deposit down. Again, not to related parties of the borrower. And as I say, with any pre-sales, there is a sunset clause date where the builder has to have completed the property by normally 3 or 4 years, but our maturity date of our loan has to be 6 months before that sunset clause date.
Perfect. Thanks for that, Steve. And if we're holding 100% build cost, how do they fund the initial 5% deposit?
Okay, so on what we do is we lend on a cost to complete basis. So therefore, with a lot of the major type builds, we don't release deposits on the major type loan type transactions, the big commercial stuff, because we lend on a cost to complete. However, that said, if the loan to value ratio up front, and they put a significant amount of equity in, so for example, if the loan to value ratio up front is say a 45 or a 50% LVR, we may consider releasing a 5% deposit, but our normal stance is our construction is held on a cost to complete basis as verified by our valuers or our quantity surveyors. So we do not normally release deposits on your major type transactions. We can consider on a case by case, and we do get it a few times, that can we release a deposit, a 5% deposit, or even be a 10% deposit. We have to take it into account on a case by case, and as I've mentioned, if the as-is amount that we've advanced is reasonably low in that 40 to 50% mark, we may be able to consider releasing deposits, but on multi-unit, not normally.
Great, thanks, Steve. Well, that brings up the end of the hour, and the questions are absolutely rolling in. So perhaps we may do a part 3 or a short version of where we maybe just do a Q&A, perhaps. But anyone who's asked questions, we will be coming back to you today and tomorrow. There's a massive amount of questions, so it may be tomorrow if it's not today. But we certainly thank you all once again for tuning in and investing time out of your business into understanding more about development finance, hopefully a little bit about Latrobe Financial, and we invite you to come to us and our BDMs with any questions you have over the coming days, weeks and months, and we look forward to helping you with your development finance transactions in the future. Thanks for listening.